All right, and we're live. Welcome to the Financial Modeling Introduction Lecture. In this particular lecture, we're going to discuss more of the technical skills that you're expected to develop as you're pursuing careers in finance. For example, Excel skills, accounting, being able to build a fully integrated financial model that represents multiple businesses, whether it's a restaurant, whether it's industrial, healthcare, which is a very useful skill set that you can utilize and transfer to other areas of careers, not just in finance, whether you want to work in tech and even in healthcare. These are all transferable skills that you can develop as an analyst and apply anywhere else. As you can recall, in the last previous lecture that we did, we explored careers in finance, in tech, consulting, and even on the buy side. So today, this particular lecture, it's going to focus more on the core technical skills. So we're going to first focus on the concepts, some of the theories, and then actual practical application by building a mini merger model, if you will, more actually on a P&L basis, not integrating a merger model, I should actually say. And we're going to be able to see how we forecast an income statement, balance sheet, cash flow statement, and how they all integrate with one another in a fully circular model. So with that being said, let's dive right into the lecture content that we've put together for this particular lecture. So what are the goals and purpose for this particular lecture? So number one, of course, is to focus on transferable skills and techniques, like I've previously mentioned. We can also focus on having the ability to understand core financial statements. How do we project those statements? How do we arrive to the assumptions that ultimately drive each specific line item? In addition to that, be able to apply theories and methodologies applicable to all types of businesses. And again, this relates to a business in construction, in healthcare, in tech, even in brick and mortar retail, or even a restaurant business. So these skill sets can be applicable to any type of business. In addition to that, have the ability to test and analyze impact on future earnings performance. This is, of course, having the ability to run multiple scenarios through your model. Are you going to run a bull case, a bear case, a management case, or a Wall Street consensus case that as you run multiple scenarios, the cash flow that you generate from each scenario, you have the ability to perform valuation to come up with a reasonable value on the enterprise or a reasonable share price valuation. And of course, Excel practice. Now, from an experience standpoint, what you might expect to gain is read and interpret financial reports, crafting financial projections, Excel practice, and error-proof your model. This relates more to sanity check. Are forecast numbers, are they in line with historical benchmark analysis, like SG&A as a percentage of revenue, cost margins, gross profit margins, general and administrative expense as a percentage of revenue, etc. What is the variable change when we're looking at historicals with what we're forecasting the business? So the way we're going to lay out this particular lecture is going to be in one part. It's going to focus primarily on the core sets of financial statements and how do we forecast each and every one of those statements. So let's go into the actual material of this introduction. So what is a financial model or financial statements modeling? Quite simply, simplifies or represents financial performance, historical, and future projections of a company. In other words, it's just a digital representation of how much money the company generates, what are the expenses associated with those revenues, and what is the bottom line? Is it profitable, which is your net income? That's essentially what financial statement modeling is all about. It is a digital representation of your company's P&L, cash flow, and balance sheet numbers. That's it. Now, in terms of core statements, which I just mentioned, we're focusing on income statement, balance sheet, and cash flow statement. Of course, there's more supporting schedules that gives us a higher degree of accuracy once we're building the model that we're going to cover a little bit in this particular lecture. But because of the time constraint, we're not going to build those things out in our Excel financial model. Now, here's a short break. If you're enjoying our content, don't forget to visit our website, romeromentoring.com, and check out our starter analyst programs, where you'll learn financial modeling, investment analysis, valuation, and develop the skills professional analysts apply on the job each day. In addition to that, you'll have access to our platform and exclusive access to content relating to investing, stock analysis, opinion, and much more. Join our growing analyst community and level up your skills today. Now back to our content. In terms of building a full-blown financial model, what type of skill sets are we utilizing or are we applying? Because financial modeling is a blend of multiple skills. And if I listed right here on our PowerPoint slide, you can see what those skills are. So number one, knowledge of the company's operation. When we're talking about knowledge of the company's operation, you need to understand how the company makes money. You need to look at an organization from an engineer standpoint, right? An engineer purpose is to identify a problem, come up with solutions, design the mechanics of whatever system that they're going to create. It's the same thing for a business. How does this business generate capital or generates money, I should say? If you look at the business from multiple little variable points, you need to understand pricing. You need to understand their market strategy, their competitive advantage. How do they communicate their message to consumers? That relates to marketing and advertising. What about their sales funnel? What about the culture? What is their product and service and value proposition? Do they have a correct pricing strategy? I mean, these are all of the variables that you need to understand as a business analyst when you're trying to comprehend and become familiar with the company's operation. That's exactly what we're referring to with that particular point. Number two, industry knowledge. If we take a deeper dive in understanding industry knowledge, you want to know more about the largest competitors. What is the market share? How fast is that industry growing? Okay, what are the product offering or competitive service and products that your competition is offering? What's their value proposition compared to your particular company? What about regulation? What about technology? Again, there's multiple variables that you need to account when you're doing industry analysis to catch up to what's really happening. What is the perhaps underpinning drivers that grow that particular industry? Or more importantly, what is the consumer behavior? So consumer psychology that determines how they purchase that product or service within that industry, okay? Number three, you have accounting skills. With accounting, do you understand the financial statements and how do they correlate or relate to one another? What about general accepted accounting principles? Are you familiar with that? What about each individual line items on the balance sheet? Do you understand it? What about journal entries, the difference between debits and credits? So these are the accounting skill sets that you develop either in Principles of Accounting 101, you can pick up a book, or even in our own financial program, the Analyst Prep program, we focus on accounting skills and what they are and what they mean. But from a practitioner standpoint, how do we apply when we're building financial model? That's one of the most important skill sets that we account for when we're forecasting financial models. Number four, corporate finance. Is it worth to invest money today? What is the value of our cash flows? It all comes down to time value of money. This is all finance 101. How do we generate capital? How do we deploy that capital? What is the return on invested capital that we're generating within the organization so that we can make more efficient, smarter decisions to grow the business? Number five, interpreting and reading SEC filings like the 10Ks and 10Qs. Obviously, Excel skill sets. Do you understand the shortcuts? What are the functions that we use that would help us make our model more dynamic and apply if statement scenario? What about toggling through different tabs or spreadsheet? Can you do that in an efficient manner to accelerate the time that it takes you or reduce the time that it takes you to build the model? This skill set is very, very important. And lastly, of course, attention to detail. Does your number make sense? Are your numbers reasonable? Can you defend them? Okay, so all of these skill sets that you see right here, when you blend them together, it's a set of skills that are transferable to any other career path that you might decide to choose after you embark on a financial analyst or investment banking career. Maybe you want to break into tech or any other industry, right? These are very important skill sets that you should all develop while you're an undergraduate student before you get either your first internship or you actually get your first full-time job. Why is that important? The reason why it's important is because it takes you about 6 months to a year to develop all of these skill sets when you're working full-time. And during those 6 to 12 months, as you're developing these skill sets, you might be working on very complex projects that you may not fully understand because you're still learning accounting. You're still learning how to navigate with Excel. You're still learning how to read or interpret an SEC filing. If you understand these skill sets at the undergraduate level, once you start as a full-time analyst or whatever other job you decide to embark on or accept, now you're applying these technical skills, but you're also understanding the bigger picture. You're understanding what your senior banker, if you will, or even your senior portfolio manager is really thinking about when they're coming up with decisions. If you're able to understand the higher level thinking and apply your technical skills to become a productive member or add value in the overall team, that is a very, I should say, a very effective and highly productive junior analyst at a level that most individuals are not going to be able to perform. So it's all about productivity. It's all about really understanding the bigger picture and all of the questions, the process, the analysis that goes behind the scene that a senior level staff member of your team would really be creating. If you could do that as well as a junior analyst, you'll be able to move up the hierarchy at a much faster pace than someone else that doesn't have these skill sets. That's why this is so important, to really accelerate your learning curve and also accelerate your career. Okay. Now, how many different types of financial models are there? There's a couple. The one that we're going to focus on in this particular lecture, it's going to be an earnings model, okay? Profit and loss, which covers the income statement, the balance sheet, and the cash flow statement. Other models are recapitalization financial model, are merger consequence models when companies are engaging in mergers and acquisitions. Discounted cash flow modeling, this is more on the DCF to determine the valuation of a business. Leverage buyout model, which is more of what you would expect a private equity associate to build, because this is normally in the course of business that they are engaging. When they're buying a company, they are buying it utilizing debt. They put a little bit of equity, and then the cash flow that the business generates pays down the debt, hence leverage buyout. All right. So in this particular slide, I've listed normally the steps that you would consider when you're building a full-blown model. However, for simplicity purposes, in this particular lecture, we're only going to focus on, number one, setting up the core model. Number two, forecasting our financial statement model. The other sections that you're seeing here, or the other steps like depreciation, working capital schedule, forecasting the balance sheet, forecasting the cash flow statement, a stockholder's equity schedule, and a debt schedule, we would cover this in a more deep level of analysis, in a more comprehensive lecture format that gives us a lot more time to dive deeper into each and every one of these concepts. But for this particular lecture, we're not going to cover this. We're going to focus on financial statements modeling so that you can understand the core technical skills on how do you forecast each and every one of those statements, but more importantly, the relationship, okay? So the financial statement forecast, what we're going to look at, it's not going to be on this particular slide. This focuses more, a little bit more of the modeling step. So traditionally, again, you will build the income statement followed by depreciation schedule, working capital schedule, intangible. The ones that are colored in yellow are supporting schedules. We're not going to do that in this particular exercise. The one in blue, the financial statements model, will be the statements that we're going to actually forecast. And here is our exercise. This is the income statement template, okay? Notice that number one, in terms of first steps, will be create each line item, which we already have: price, volume, revenue, cost of goods sold, gross profit, SG&A, EBIT, all the way down to net income. Then use research management projection to forecast. In this particular exercise, the projections for revenue have already been provided to us. Here it is. We're going to assume a growth rate of about 2%, which is historically the growth rate of inflation. And number three, we're going to use the drivers from our model or our Excel tab as our growth rate and our margin assumptions. Where do we get the margin assumptions? Well, we're going to be calculating it. So we're going to be calculating margins for cost of goods sold, SG&A, and we're going to use these margins to flatline and help us forecast the operating expenses line of this income statement. We have the balance sheet. How are we going to forecast the balance sheet? Well, what drives the balance sheet is our working capital assumption. You see down here where it says working capital? Okay. We're going to calculate those ratios for each and every one of these line items: receivables, inventory, accounts payables, and accrued liability. And I'm going to explain a little bit more what each and every one of these line items, the turnover ratios, what they mean, what they represent, and how they can help us make better forecasting decisions when we are forecasting the balance sheet. And lastly, our cash flow statement. Okay, the cash flow statement is essentially the representation of cash that comes in and out of the business based on transactions relating to our normal course of business and operation. One of the things that we are forecasting on our balance sheet that you see here is our CapEx, okay, which is going to be 500. All right. And once we finish forecasting the model, we're going to make it fully circular. Okay. And what fully circular means, linking it all together, okay, is that we're taking our interest income and we're linking it back to our income statement, or it's going to be part of the net income. And when you actually do that, your net income on the income statement, which is the first line item of what? Of your cash flow statement, you're going to see how this impacts the balance sheet and how the balance sheet impacts our interest income, which ultimately impacts our net income. Essentially, it becomes a fully circular model, or in other words, you're self-referencing to obtain a variable, right? If you need X to solve for X, well, how can you solve for X when you need X? It's like, what comes first, the chicken or the egg? That's what we're referring to when we're talking about self-referencing within a fully circular model, all right? So with all that being said, let's dive into Excel so that I can walk you step by step on how to forecast each and every one of the financial statements that I've discussed in this presentation, all right? So let's pull up the model, Excel. Here it is. And by the way, you're going to be able to find this in our Finance Success Track platform under week 2. All this information is going to be there. The video is recorded, is going to be uploaded as well. And this Excel model will be there. All right. So with that being said, let me actually adjust a little bit of the sizing. Okay. And let's move to our mini model. Here it is. So notice we have the income statement. Okay. We have the balance sheet. And we also have the cash flow statement. All right. And let me actually adjust the frame here so that it's easier to navigate. And you can see my video framing on the top right-hand side. There we go. I think that's great. So in terms of forecasting your income statement, right? The first thing you need in this exercise is your top line growth projection. In this case, your revenue growth assumption. When we examine this model a little bit closer, you see that the revenue, total revenue, is really driven by 2 variables, price and volume. This is a very basic business model. We can assume that they're selling widgets, they might be selling pens, they might be selling a phone. It's a very simplistic model. And also, if you see this price point right here of $10, what items do you think would be sold at a $10 price mark where the company will be selling in terms of volumes of 1,000, right? If you really think about this, what price item do you might consume or buy on a daily basis that would be around $10? This is where I'm asking for a little bit of participation now. Let's see what comes in terms of response. Let's see. Clothing, okay. A hat, okay. Shirt, okay. Lunch, Okay, okay, all right. Okay. Lunch, what else? Sneakers for $10. Okay, that's fine. Flip-flops. Okay, so it could be any type of tangible product, right? So let's first focus on historicals, which is 2018. Let's go ahead and calculate net income. I want to find out what's my revenue and what are my margins, of course, because we're going to use those margins to help us forecast our operating expenses. So the first thing you want to do is take your price and multiply by volume. This is an estimated number of sales or revenue, okay? And note that these numbers are in thousands. So this right here would be what? 10,000 or 10 million? Well, remember, because these numbers are in thousands, this right here would be 10 million, okay? And let me put in one decimal place so that distinction is made a little bit more clear, all right? Revenue growth, obviously, we could do the current year divided by the previous year minus 1, but because we don't have any reference point for before 2017, we're just going to get an error or a pound divis sign, okay? So in this case, just leave it at 0 or just put in a reference dash line. So what is my cost of goods sold margins? Equals. Take your cost of goods sold and divide it by revenue. And because we want our numbers to be in absolute, make sure you either put in ABS for absolute numbers, or you can also insert a negative value. But this is still not in the correct format. What do I have here for line number 16? It says margin as percent of revenue. So we need to convert this into the correct format. Formatting is very, very important when you're building financial models. So I'm just going to press Control-Shift number 5 to get the correct format. And I'm going to change the color here. All right. Now, for those of you that might be using a Mac, don't worry too much about the shortcuts. And for those of you that are also using a PC, don't worry too much about the shortcut. I just want to walk you through the steps so that you can see the thought process, the framework behind forecasting a financial model. So the first step here is to focus on the historicals, all right? So what is my gross profit? Let's take equals. Total revenue plus cost of goods sold is my gross profit for that particular period. What is my gross profit margin? Take your 7,000 and divide it by your revenue. There it is, 70%. Then we have SG&A, which deals more with selling the product, your sales force, marketing, advertising. In this case, it's 3,000 or 3 million. Let's take 3 million and divide it by revenue. And of course, let's do ABS, or even let's actually put in a minus sign so that you can see how we convert it into a positive number. Now, what do these margins numbers mean, or what do they represent? Right? Let me highlight them for you. Here we go. Okay. Gross profit margin and cost of goods sold. Essentially, when you want to boil it down to a simplistic answer, it means, from an SG&A standpoint, per every dollar of revenue that you generate, 30 cents is going to go into your employee salary, your marketing budget, your advertising budget, and any other type of overhead costs that you may have, like rent, utility, legal expense. That's what SG&A represents. So for every dollar of revenue, 30 cents is going to be allocated to facilitate or fund all of those expenses. When we're talking about cost of goods sold, COGS, this is 30%. All it's saying that for every dollar of revenue, 30% or 30 cents is going to go into buying the raw material, the supply that you need to manufacture or create your product. That's all it essentially means and it represents, okay? So let's continue here. So let's calculate now EBIT. EBIT stands for earnings before interest and taxes, which is another word for operating income, okay? How do we calculate operating income? We take our gross profit less our SG&A. There it is, 4,000. Then we have interest expense, interest income. Let's get the net of these two. It's minus 500. My pre-tax income, it's going to be operating income less my net interest, and it's 35. Then we have taxes. We're making the assumption that we have a 25% effective tax rate. So we're going to take our 25% times our pre-tax income, and this is how much we're going to be paying in taxes, $875,000. And the last step is to calculate our net income, which is going to be equals. Take your pre-tax income and subtract taxes. That right there is your net income. Now, from a historical standpoint, we can see what are the expenses associated with this business, which can help us estimate or forecast what those expenses will be. Remember, for every dollar of revenue that we generate, 30 cents goes into SG&A and 30 cents goes into buying your raw materials and supplies to manufacture your products. So we can make the assumption that under normal business operations, under normal conditions, we can anticipate that this company will maintain that same level of structure, that same margin. So here's what I'm going to do. Number one, for cost of goods sold equals, I'm going to set 2019 equals to 2019 equals to 2018. There it is. And I'm going to drag it across to the right. I'm going to do the same thing for SG&A. I'm going to set it equals to the previous year and drag it across to the right. There it is. And of course, I'm going to do the same thing for my taxes. Equals. Set it equal to the previous year, drag across to the right. And for the most part, now we have all of our driving variables that will determine our top line revenue number, will determine our cost structure expenses, and our bottom line number, which is net income. So let's go ahead and first populate the first year, which is 2019. And we're going to do as follows. So my price is going to grow at the rate of inflation, which is 2%. That's what I have here in terms of revenue growth. So how do we do that? And this is best practice. So the way we do it in Excel, we're going to do equals. We're going to set to the previous year price times, open parentheses, 1 plus reference to my growth driver, cell G11, close parentheses. There we go. Why do we do it this way and not inside the formula type 0.02? Why do we do it that way? The reason why we do it that way is because it helps us make the model more dynamic. It allows us to drive our assumptions outside of the cell. And it's just easier to audit your model. Let me show you an example of what I actually mean. So if I come here, right, if I change this 2% to 5%, notice that this doesn't move. It's not dynamic. It is not dependent on the cell, which it should be. If I need to change this, then I have to press F2, come in here, change it to 5%. You see, it involves a lot more steps in order to do that. So to prevent from doing this, we have the driving cell number linked to outside of the formula, the way we have illustrated right here. So if I press enter, and now if I change this percentage from 2% to 5%, you can see now why we do it the way I illustrated. It becomes more dynamic. Okay, so let's change this back to 2%. Volume, we're just going to assume that volume is going to stay constant. Okay, and my revenue, it's going to be price times volume. And let's calculate the percent growth change. So 2019 revenue divided by the previous year, 2018 revenue minus 1. And let's change this to percent. And here it is. Now, my cost of goods sold. Remember, cost of goods sold is going to be 30% of my total revenue. So equals 30% times total revenue. Enter. And let's change this to black. Okay. What's next? Gross profit. It's going to be, actually, this should be minus. And let me edit the format for consistency purposes. There we go. All right. Gross profit will be my revenue minus or plus, in this case, because gross profit is a negative number. We combine those together and we have our gross profit number. We can calculate the margins. So take your gross profit divided by your total revenue for 2019, and that gives you your gross profit. SG&A, we're going to take the 30% and multiply by total revenue. There it is. And of course, minus signs. And let's also change the format. I'm just going to copy the format for cost of goods sold and change the format, copy and paste the format. There it is. And of course, we have our EBIT. EBIT's going to be gross profit less SG&A. My interest expense, I'm going to flatline this number for now. My interest income, I'm going to leave it 0. And I'm going to highlight this because my interest income will come from my cash flow statement. We're going to calculate my cash balance at the end of the year, and we're going to calculate the interest income on the cash balance that the company has sitting in the bank, on a checking account, on a money market account, where they are generating or collecting interest income. That's what's going to be here in this line, road number 23. So what is my net interest amount? Take your interest expense plus your interest income. Pre-tax income will be operating income less net interest. In this case, is going to be 3080, I should say. And lastly, my income tax is going to be my 25% effective tax rate, multiply my pre-income tax rate. There it is. And of course, net income is pre-tax income less your taxes. And there is my bottom line number. Now, once you have your first year built correctly, 2019, one thing that you can do is highlight all of the rows for 2019. And if you have a PC or even with a Mac, if you hold Shift and with your arrow keys on your keyboard, press to the right side, and then you do Control R. This works in a PC, the shortcut. Control R populates a formula all the way to the right. And there we have projected our income statement. Now, there's a couple of things I want to touch on here so that you can understand. And let me pull up here my color toolbox. Here we go. So as we did this, what was the first step that we did? The first step was to calculate our 2019 numbers, but more importantly, what were the costs associated with every dollar of revenue that came in? So for example, cost of goods sold, it's a 30% margin. So for every dollar, 30 cents was allocated towards buying the raw material and all of the supplies to make that sale. SG&A for profit margin of SG&A is also 30%. So once you have the product and you sell it, what goes into selling that particular product, right? So you have your marketing distribution channels. You have advertising expense. You have your sales force. You may have customer service. You may also have your administrative expense like rent, utility, legal expenses, etc. So for every dollar of revenue, 30 cents, it's allocated into SG&A expenses. That's what we had calculated right there. And also at the bottom, we have our effective tax rate, okay? These three lines are perhaps one of the most important line items that drive our revenue. But if we look at the top line, I should say that drive our income statement, not revenue. To drive revenue, those numbers are the drivers right here on road number 11, 2%. So when you're looking at this income statement, you could really boil it down or simplify it to four main drivers: revenue, cost margins, SG&A margins, and your effective tax rate. That's it. Those four numbers is what's driving this income statement. And we can take this very simplistic income statement model and apply it to a more complex business that may have multiple line items in their operating expenses. A good example of that, if I pull up the screen here, company filings, fast search, let's type Chipotle, okay? And let's look at the income statement of Chipotle and look at the line items that they have, which is a little bit more detailed than the very basic model that we just created. Let's put up the 10K because it's the annual report and it gives us a lot more information. Here is table of content. Let's go to financial statements. Here's the balance sheet. And here's the income statement. So let me pull up my drawings. So from an income statement standpoint, look at all of the costs associated with running Chipotle, okay? If you wanted to forecast each and every one of those line items, you could do it as a percentage of revenue and get the margin. Then you have the other ones like general administrative expense, okay? You even have depreciation and amortization, which you can either do it as a percentage of revenue or you could do a depreciation schedule to either depreciate their property, plant, and equipment or even amortize their intangibles. You also have pre-opening costs and asset impairments. So this is another more perhaps detailed representation of an income statement of a restaurant, okay? So I just finished walking you through perhaps the steps or the process of how you can forecast a company income statement by just calculating their expenses as a percentage of revenue to give you perhaps an estimate of what would that number be going forward into the future. And the reason why we do it that way is because this is already a proven business model. This is a proven concept. We can easily assume and predict that Chipotle food, beverage, and packaging costs will grow at a very constant rate, or would grow in line with revenue, right? So if revenue grows, your food and beverage packaging will also grow. So that's why it will grow as a percentage of revenue. And the reason we do this because it's already a proven business concept. It's a proven business model. If it was an unproven business model, if it was a startup, it would be a lot more difficult to forecast the income statement. When you're dealing with unproven business models, especially with startups, it's a lot more difficult. And that requires a whole nother level of insight and experience to forecast a startup that we're not going to touch on or even cover today. Those are things that we focus more in our analyst prep program. So let me revert back to our Excel model. And let's just put right here, let me zoom in a little bit, or actually reduce the spacing here. And for have a reference, let's type steps, modeling steps, just to perhaps summarize what we've done up to this point. So there's a couple of steps here. So what did we first do? We did historical financials, okay? Then we did what? Calculated COGS and SG&A as percent of revenue, okay? Then after that, what do? We forecast income statement per revenue and operating COGS and operating, which is your SG&A expense, SG&A margins. Okay? So these are perhaps the three basic steps that we just performed to calculate this income statement. Okay? Then the next step is to forecast our balance sheet. Now, with the income statement, we had our drivers, right? Revenue, cost of goods sold margins, SG&A, and effective tax rate. With the balance sheet, we can follow the same concept or the same principles, but we're using different line items. With the balance sheet, we're looking at working capital ratios. These working capital ratios, it's what's going to allow us to see how long it takes the company to convert their current assets into cash, and perhaps to convert their liabilities or pay their liabilities. How long does it take them to basically pay out their suppliers, their employees, the rent, etc. So let's go ahead and calculate these working capital ratios. Okay, so here we go. Receivables. So in order to calculate receivables, how long it takes a company to convert their receivables into cash, we need to do the following. Equals. We're going to take receivables and we're going to divide it by revenue, total revenue, times 365, 37. This 37 number, essentially, we should say, actually, let me copy and save this, okay? Here we have receivable days. Essentially, this means that it takes a company about 37 days to convert their receivables into cash. Now, if you're not familiar with what receivable means, it's because you haven't taken accounting. These line items, you learn what they are and what they represent in Principles of Accounting 101. Of course, we dive and explain all of this in our analyst prep program when we're diving into accounting principles as well. Another thing that you can do, go to Google and type each and every one of these line items so that you can familiarize yourself with the concepts and what they represent, okay? Let's go ahead with inventory. So for inventory, we're going to do equals. Take your inventory from current assets, divide it by your cost of goods sold, and multiply by 365. Why 365? Because that's how many days there is in a year. And of course, we want this number to be absolute. So we're going to put the ABS format. And there you go, 61 days. It takes us about 61 days to replenish all of the inventory. So if you have a warehouse with a lot of supplies and raw material, it takes you about 61 days to reorder all of the inventory that you have there, because it takes you 61 days to just sell it or use it to create a product. It takes you approximately 61 days. So let's continue. Now we're going to go to the liability side. For accounts payable, we're going to do accounts payable divided by cost of goods sold times 365. And again, let's convert this. Let's actually just put a dollar sign. Let's keep it simple. So 122. In terms of days, right? Accounts payable is the amount of money that you owed your creditors, your suppliers. A great example of this, let's say that we are running a business where we are manufacturing, let's say, teddy bears, right? And what is the raw material that we need in order to make a teddy bear? You need textile, you need cotton, you need a sewing machine, you need yards and strings. So when you order all of that, you're buying it from your suppliers and you say, hey, just send me $1 million worth of all of the raw materials and supplies that I need. I'll pay you back within 122 days. Now, the supplier might say, okay, we've had long-lasting reputation. I know you're good for it and you have a good reputation, so I will provide you with the supplies and you could pay me in 122 days. That's exactly what that represents and what it means. All right. Lastly, accrued liabilities. So accrued liabilities will be, as you see here on our liability side, 1.5 million, sell F45 divided by SG&A, okay, times 365. And let's put a minus sign here. And this one is 183 days. And you can apply the same example. Now, of course, with SG&A, it's a little bit different from cost of goods sold because SG&A takes into account what? It takes into account our marketing budget, our advertising expense, our sales force, our employees' labor, legal, administrative, utility, rental expense. So there's a lot of expenses mingled in SG&A. And in this particular example, we're saying it takes this company about 183 days to pay all of their operating expenses in full. All right. So how do we use these ratios? Well, the way we use these ratios is that we're going to set them equals for 2019. We're going to set them equals to the previous year. And we can easily just forecast it across to 2023. And you're going to see how we can solve for each and every one of these variables that we ended up calculating the return ratios for. So inventory and receivables, and the same thing for accounts payables and liability. All right. So first, also, before I do that, let me go ahead and calculate my total assets and total liabilities to make sure that my balance sheet actually balances. So my total current assets, we're going to take into account cash and equivalents, receivables, and inventory. There we go. Total assets will be current assets plus my net PP&E, property, plant, and equipment. Notice that my balance sheet check is off. It doesn't match, right? Because we have to calculate it for liabilities and stockholders' equity. So let's calculate the total current assets. In this case, it's 3 million. My total liability will be current liability plus long-term debt. There it is, 4 million. And let's take our stockholders' equity. Just take the sum of all of your stockholders' equity line items. There it is. So my total liability in stockholders' equity is 6.5 million. When we take the difference between the total assets and total liability in stockholders' equity, we arrive to 0. Okay? And the next step will be to forecast each and every one of these line items. And we're actually going to do that in our next lecture. So in the next lecture, we're going to complete the balance sheet. We're going to complete the cash flow statement. And then we're going to link the cash flow statement interest income up here to our income statement. And I'm going to highlight that line right here. This is where we're going to plug in the number or the information. All right. So before I sign off here, is there any questions? I want to check in with you to make sure that everything is okay. And let's see right here. Yeah. Yes, John, it's being recorded. I will be uploading the first part of this financial modeling lecture on the Finance Success Track Week 2 module. Okay. All right, great. So if there's no questions, then I'll see you tomorrow where we're going to complete, again, the balance sheet and the cash flow statement and link the interest income to our interest income line in the income statement and give you a better representation of what financial modeling is, what are the steps associated with building a fully circular model. So with that being said, folks, I'll end the session here and I'll see you in the next lecture. Take care.